today, when you go to maybe a cocktail party, somebody says, how many months has the S&P 500 been up? You're going to say it's been up 9 in the last 10 months. Amaze your friends. But your next guest says September setup looks more treacherous, he said, for stocks, and he spies one sector that could be vulnerable to a pullback. Let's find out what that is. Jonathan Krinsky, Chief Market Technician at BTIG, joins us now. Jonathan, suspense is killing me. What is that sector?
Hey, Brian. So the sector is the consumer staples sector. It's been really strong of late, and so much so that the weekly RSI, which is the relative strength index, a gauge of momentum, is above 74. It's the highest it's been in 10 years. And so we look back since the year 2000, whenever the XLP, that's the ETF for the consumer staples ETF, whenever that weekly RSI has been 73 or higher like it is right now, the average return looking out 1 to 8 weeks has been pretty negative. 2-week returns on average have been down about 2.4%, down 7 of the last 10 times. And, that's not a big move. May not sound like a big move, but for the consumer staples, which is a lower beta, lower volatility group, that's a decent move. And so, I think structurally the staples chart looks still pretty good, but I think tactically, as we head into September, it's a group you may want to pump the brakes on here.
Does it look like it's just too red hot in a short term and it's still a solid long-term setup, or probably most of the gains have already been made?
No, I think that's your point. Structurally, I think it's still fine. This is more if you've been a little more nimble, a little more tactical, and you've been in the staples trade for the last couple of months, maybe take some chips off the table and look to reset it as we pull back. I think there's been a lot of we'd call it pre-trading the rate cut move, and so I think they've maybe benefited from that. But we actually think as you get into September, rates are actually set to move higher, and that could also be a headwind for the staples sector.
Okay, what about, you got a view on the macro market or any other sectors? I know all we've been talking about is AI and NVIDIA and everything like this, but there's some other things that technically, at least to my semi-untrained eye, look at biotechs. There are things that are in the market that we've kind of been ignoring.
Yeah, biotech's been kind of consolidating for the last couple months under key resistance, so that's poised to potentially break out. Industrials have been very strong, both equally and cap weighted. That's a sector that just hit new all-time highs this week. So there's things that are making new highs, even though the S&P itself continues to struggle, sitting just below those prior highs. Actually, the equally weighted S&P 500 also did make a new high. So things are happening below the surface, even though the S&P itself just kind of looks a bit stuck here.
Yeah, certainly is. I know you're a technician, obviously, so you're looking at charts, but you got the fundamentals that are sort of layering on top of it. How much are you following the Fed and bond yields, if at all?
Yeah, no, that's definitely a key part of our work. And we think, what was interesting is when stocks rallied off the August lows, a big part of it seemed to be that the economic data was improving. And we've gone into an environment where good news is perceived as good news, so that made sense. But what was notable is that bonds also rallied on that perceived better news. And if they were rallying during the August volatility on the bad economic news, it didn't really make sense to us that they would also rally on the good economic news. And so we've been saying to fade the strength in bonds, especially as we get into September, which is September, October are the two worst months for bonds, surprisingly, maybe. October has been down 8 of the last 9 years for bonds. September, pretty much the same. So we think bonds are a fade here. And I think some of the buying in bonds was, again, front running an anticipated Fed rate cut. So you could see a sell the news there. We think stocks probably hold up better. You might have to wait till the back half of September broadly before volatility reemerges there for the equity market.